Good afternoon and welcome to Edelweiss Leadership Unplugged. We are pleased to have you with us. And today I'm privileged to welcome a legendary banker who invested over 45 years of his career to banking in India in various roles, ending up in leading and building up one of the largest private sector banks of India. We have with us a banker who is greatly admired globally and in India for all that he has done for the Indian banking industry. Well, he turned entrepreneur at the ripe age of 58. And as I said, he is credited with creating one of India's most profitable, sustainable, and very high growth banking business. He has been awarded the Entrepreneur of the Year, the most valuable CEO of India, and the Banker of the Year by numerous publications and institutions. It's my privilege, as I said, to welcome Romesh Sobti, ex-MD and CEO of IndusInd Bank. Mr. Sobti, great to have you with us. Thank you for joining us today. Romesh, welcome. Thank you for being with us. It's great to have you.
My pleasure.
I hope you're doing well. Family is good.
Yeah, doing well so far. Family is scattered all over. It's just the two of us here for the last 6 months, but things have gone fairly well so far.
And I hope a busy banker like yourself is finding productive use to your time ever since you retired from the bank.
Well, to be honest, this was a double whammy. So my retirement started from the 24th of March, and the lockdown started from the 24th of March. So one, of course, was leaving the bank, and that the daily sort of grind, if you would call it. And the two is, of course, being confined and not being able to sort of go out. But I think we all have adapted well. So have we.
Right. And as we were discussing, Ramesh, today's conversation, it'll be very useful for us and our listeners here and the viewers here to get some insights from your leadership journey, from your journey as an entrepreneur, and also your experiences in building up an institution. And if with your permission, if I may just dive in with a question that's on the top of minds of our customers, is navigating crisis, times of crisis. And if I recall, you joined IndusInd Bank in 2008, just before the global financial crisis. So that hit. And in 4 years, again, you saw the taper tantrum and the fragile five situation in the country. And again, in 2018, you saw the IL&FS debacle. So just if you could talk to us through your journey as to what does it take to navigate and what are the decisions you made? How did you go by?
Yeah, I think each one of these sort of crises created learnings which you sort of absorbed. And if I was to sort of look at common themes that run through all these crises and how you cope and grow, I would say that there are 3 or 4 items that really come to my mind. One, of course, is that when a crisis hits, a coping strategy has to sort of come into place. That is to ensure continuity of businesses, right? I think that's standard textbook sort of response to crisis, ensure continuity of businesses, right? And I've seen that typically the textbook response is cut your costs, right? Let go of people, slow down on businesses, reduce your capital expenditures and things like that. And some of that may have been justified. But I think that if you keep a longer perspective, don't lose sight of so for instance, we went on these 3-year plans. We never lost sight of a 3-year plan, no matter which crisis came up. So one, stay focused on the businesses, right? The two is actually reiterating your goals, your objectives. We said in 3 years' time, we want to do this, this, and this, right? That reiteration must happen. And that then you've got to decide, whether the crisis is creating a course change, it demands a course change, or it demands fine tuning, and you react accordingly, right? So don't take knee-jerk reactions to this thing. And I think the most important part that I have seen is that communicating. My experience is that most effective managers in crisis become huge communicators, and visibility is one of the outstanding features of people who are effective in a crisis. And that communication is really internal. A lot of it is internal. Of course, you communicate with your customers. You share also and create confidence building with your investors. But a lot of that communication is with your internal system. That this is what we set out to do. We stand by this thing. This is our crisis today. This is how we are coping. And, it's never done through the written word. Sending out a mail is the last thing that you would do. You need to be seen and heard. People need to see body language, right? Are you beating your chest? Are you losing your cool, right? Are you saying, yeah, these are the problems, and this is how we are going to face those problems? I think that's this thing. And then, of course, you search. During the crisis, you also search. And I'll give you an example, since you mentioned the global crisis. You search for opportunities. And, if I was to trace the 12-year journey of IndusInd Bank, then one of the milestones that I remember the most is the Lehman crisis. We were 6 months into the turnaround story. The new management change had come. And 6 months later, I think in October, the Lehman crisis hit. We were still sort of hoping. We didn't have the product suite. You were the lowest cost financier in the market. People beat you down on the pricing and say, why should I do business with you? You don't have products. Then came the Lehman crisis, right? And the Lehman crisis brought an opportunity. We were one of the few which managed to get liquidity. Liquidity dried up absolutely. We were one of the few which managed to get liquidity. We used that liquidity to make friends in the corporate world. The same corporate world who would not look at us and say, okay, you are the 20th bank, so give me a term loan for 7 years at 7%. And then, of course, the opportunity was to reprice. So the opportunity was both to make friends and also appropriately price your businesses till you build up the suite of businesses. So I would say the Lehman crisis actually gave us a solid fresh wind to sort of cope. And of course, there were learnings on how to manage liquidity and things like that. So I think, but communicating that to your own people is very, very critical part. So I think these are 3 or 4 themes that become almost universal, no matter what type of crisis comes your way.
Thank you, sir. And you mentioned about never losing sight of your objectives. So amidst all the economic cycles you went through in the last so many years, so what were the non-negotiables? As in, these are the 3 things we will not stop investing in. This continues, whatever may come.
Yeah, I think for us, investing in people, because the organization was starved of talent, that never stopped. Actually, the crisis created availability of good talent. And therefore, we leapt at that opportunity because there were others who were shedding as well. And at that stage, we were taking people. So we got talent. And of course, part of the talent came with the challenge that come and participate with us. We have some beliefs. If you join us in the beliefs, you also will enjoy the benefits of that. I think we never stopped investing in this thing. Then the 3-year plan, we call them planning cycles. They envisage a certain amount of investments, for instance, in technology. We were solidly impaired on technology, I would say. Of course, there was an old core banking system. We never shirked investing in a core banking system and the technology and all sorts of things. So these are two areas that is the thing. And I think the third one, of course, is customer building up the customer base, right? So never losing track of the customers. So what we call new to bank customer, this thing, that through all these crises, we maintain that stance and that focus.
Right. And if I may ask you, you mentioned about whether it's a course correction or not. Are you completely, permanently altering your course or not? At any point of time, did you go through such a situation where you had to say, this plan is shelved? Now let us create a fresh plan because what happened, whatever has happened impacted us so deeply. The past doesn't hold any good.
So let me pick another milestone, which was the ILFS milestone, right? And I think that it's well known in the market that the ILFS left a deep impact on the bank itself, as it left a deep impact on the market as a whole. And then there was this huge sort of hue and cry and inquisition, if I would say, on, what have you changed? Have you changed your risk practices? Will you do this business or that business and this and that? Now, we said yes, there are learnings, right? It was a misstep, right? Caused by many factors. A lot of them are external and things like that. But it doesn't mean that we'll now stop lending to the corporate world. That's a course correction. And today you see the chorus you hear now is, I'm going retail.
Yeah.
Right? Because the corporate book has given pain. I think that's a very short term sort of a this thing. I think that this averseness is going to create opportunities because a lot of people are vacating spaces. For instance, infrastructure financing. It's a space completely vacated. And I'm telling you, some of the other lender is going to find their space again and is going to sort of come back. So I would say a course correction means I'm stopping corporate banking. Fine-tuning means I will not lend to certain parts. And if I lend, these are my new shields, credit shields or credit screens that one would put on there. So fortunately, in these 12 years, we've not had to face any business where we said, shut this business. It's a question of the pace of scaling up and the degree of investments pacing out, but not shutting businesses, fortunately.
Right. And also, if you could talk to us about some difficult decisions you had to take during any of these crisis periods or course corrections, anything that you had to bite the bullet and take those calls. And now you look back and say, well done.
See, the issue here is that when there's a crisis created because of, say, missteps, then the blame game starts, right? And I think one of the things that as an institution, as management, as board, everybody, they stood by people. That decision is difficult. The blame game is like a wave, and you sort of, people force you to give in. We took a decision, no. Everything we do is collective, right? That doesn't mean that accountability gets dispersed, but these are collective decisions. And so standing by the people, in spite of pressure coming in, we stuck to that sort of thing. Right? You say, yes, of course, could have done some things differently, but you're wiser after the fact. But now let's learn and now move on to this thing. That decision to not do the blame game was, I think in the end, it sort of pays off. People become much more loyal when they know that there's somebody behind their back, somebody supporting their back. I think that's a critical feature of institution building.
Right. And if I may just extend this question, Romesh, You talked about investments in people. We are aware that, five of you joined from ABN AMRO and started IndusInd Bank, and the fact that the senior team has continued. And you've again and again talked about creating trust in people, carrying people along, like-mindedness. How important that has been in the journey of the scale up. And what are two, three things that you've done differently, you think, to just create this atmosphere, environment, this ownership? I mean, what is so special?
So, the word team and teamwork is, of course, used so frequently when you discuss management and things like that. If you really sit down to analyze saying, what is a team? And the usual answer is a bunch of people who report to one person. And we have never considered that as the definition of team. I think the team definition really is that you have a set of uh, like-minded people who have what I call common compelling objectives. There has to be commonality of objectives. They all share the common and beliefs, right? And the other element of it is, and to achieve those objectives, they create solid interdependencies. That I would call as a team, not a bunch of people reporting to a CEO. That never forms a team, but a bunch of people with the same beliefs and their like-mindedness and one objective, right? And everything pools into that objective, right? So the individuality that I did this, he did that, I want this bonus, and she wants this, that sort of thing, then it doesn't go away. It mitigates to that extent. I think that is that they were like-minded people who came in with a set of beliefs, and the beliefs are born out of experience. Right between the five of us, I think we totaled up once. We had something like 30, 60, about 120 years of banking experience, even more. But there was some common beliefs. I think that is a critical feature of teamwork. Then, of course, the stickiness that you talked about, I think, and I think that's one of the features that really gives me a lot of comfort. That in those 12 years, we did not lose a single single senior manager in the management team of the bank. It's because they believe, and we went through many sort of twists and turns. I mean, you could say that people came in because you gave them stock options, but the stock varied up and down, but people stayed. And I'm happy to see that the team is intact, and nobody has actually even indicated that he or she would sort of leave. I think that stickiness is most encouraging.
Right. And if I may just ask one more follow-on question on this. We were barely coming out of 2018 ILFS debacle, and we faced this whole COVID situation. It made matters worse. And when teams go through this, there's scars on the back, their wounds, and morale is down. Belief is down. People, like you said, the blame game, and one-upmanship, or a lot of these things start. And a lot of, let's say, our clients, corporate India, have taken hard decisions on people, right? People, compensation, rewards, all of that. So what is your advice? How do you come out of it, rejuvenate, and still go at the goal? What have you done as a CEO?
Well, one, of course, I talked about this sort of the blame game, the tendency to find scapegoats. I think it doesn't pay off. It does much more damage than people think. I think that blame game, this thing, and the politicization of the blame game, right? The politics of it is this thing. Also, then uh, you stand before, right? Don't put your team to face the difficult questions. You got to stand up before that, right? And you have them backing you up. I think that's the thing that really binds people together. That somebody said, okay, I will take it on the chest, right? Because I took all the medals on my chest also, right? So a few darts also should be taken on the chest. I think that goes down very well with people.
Right.
Deep inside, we always think that it's the stock options, the value of the stock options, the bonuses, and this and that, and all the sort of things. But I tell you, you don't get up in the morning every day and look up your bank balance. Yeah? But do you remember? Uh, I remember. Which boss do I remember the most? The boss who I thought was the best human being, not the best leader, not the best manager, but he was a good human being.
Right.
Because the good human beings are good leaders.
Right.
A good leader has to be. And I think that's what really matters a lot. Everything else matters, but this weighs heavily on the minds of people.
Right. And if I may just now shift the conversation to the, let's say, the three phases of growth. I'm sure when you took over as CEO of IndusInd Bank, there must have been a cleanup phase, or the turnaround phase, and then a catch-up phase. You have to catch up with all your products, services, infrastructure, so on. And then you're going for the win. You're going for growth, profitability, scale, and so on. If you could describe to us these three phases, one in terms of mindset, your mindset, and two in terms of what measure of success were you going after in these three phases, or how were you kind of looking at it, and when did you cut over and said, hey, this is done, let's move?
Yeah, you're right. The phases were pretty clearly defined. And so when the story started, the turnaround story started, I think the major objective was, of course, to restore confidence back in the institution and to give confidence to, first of all, your own employees, staff, give confidence to investors, regulators, customers, right? So I think restoring credibility was the major issue. The loss of credibility was the issue, and that's what we baked into the first 3-year plan. That let's bring back profitability, and let's bring back productivity, and let's create credibility and of the direction that we have, and deliver. Right? I've always believed that for any form of long-term success or a strategy to exceed, short-term wins are necessary, and you must deliver those short-term wins. They create the confidence. Those were built into the first 3-year plan. The measures of success, we shied away from the loosey-goosey measures of success. As we said, these are 6 measures of success, right? And watch us on these. Right? And there was returns, profitability, productivity. So return on assets, returns on equity, interest margins, the gross to net NPAs, the revenue per employee, the cost to income ratio. I said, okay, measure us on this one. And every quarter we will measure ourselves on this. That's phase 1, So fortunately, the tailwinds carried us in phase 1, post the Lehman crisis and all. And you sort of brought it to a certain phase where they said it became respectable in the sense that you are not an outlier. To move from the outlier, you are not an outperformer, but you moved away from the outlier and you are in the middle of the roader. The next 3 years, we said, all right, let's bring little scale into the businesses. So one was profitability and productivity, then bringing scale into the businesses. The next phase was really when we started talking about market share. And then we introduced the concept of domain leadership, right? I wouldn't call it domination, but domain leadership. So we did a full listing review and said, look, in the domain of vehicle financing, we are leaders. Number 1, number 2, and number 3 in every vehicle category, right? This is one of our domain. We want market share in this domain, right? Similarly, in the domain of gem and jewelry financing, diamond financing, for instance, that's the acquisition we did. We were number 1 player. It's a domain. And what domains do is really domains create surprisingly sustainable yields. And because you are a domain expert, you demand a certain pricing and also better delinquency profiles. So the second domain. And there we said market share, right? You want to be clear, number 1. And then, of course, third came the microfinance. part of it. The third domain was created. And when we bought or merged with Bharat Finance. And so that was if you were to say the third phase, of course, there were 4 cycles, but the phases were clearly, I think, this thing. First, profitability, productivity, and return of credibility. Third, scale and profitability. Third, domain leadership and market share. That's how it panned out.
And you did mention creating market share or domain using acquisitions. What is your view on acquisitions and how do you make them work? What is your playbook?
So the acquisition story is always this, that you come as an equal. Starting point is not buyer and seller, right? We've always positioned it as a merger of equals. The need is same on both sides. The bossman relationship doesn't work, right? The second, I think, this thing is that continuity in terms of, say, employees, right? So in all our acquisitions, we have always said that not a single job will be lost. That's one of our district, right? And I still remember when we bought the credit card businesses of Deutsche Bank, there were other bidders, big bidders, and the deal was struck because we said not a single person will lose his or her job. Number one, we will protect salaries. Although it is a multinational bank coming into a private sector bank. So I think there are a couple of beliefs that we really worked on. So that is there. And third, that the acquisition should either create specialization or domain knowledge and domain leadership. Otherwise, just acquiring for the sake of acquiring is accrual of assets. That my balance sheet grows by 15% or 20%. That has never been never was a driving force. That the acquisition must give you specialization. For instance, the credit card businesses was specialized. It would have taken us 3-4 years to build that. The diamond financing business is extremely specialized and very, very touch business. Microfinance is also specialized, in that sense, and it gives you domain leadership. So I think these are the drivers behind the acquisition stance that the bank took.
Right. And if I may now shift the lens a little bit from a CEO to a banker and a banker to corporate India. The question I have for you, Romesh, is that why do so few companies scale in India? The small companies remain small. This journey from small to mid is, very hard for most of them. Then mid to large is equally harder. So what have you seen? Why do so few make it? Why India is so polarized or skewed towards very few people or very few companies on the top?
I don't know whether there's one clear answer for every one of these cases, but I think those who stuck to their knitting and created scale in their own businesses and remained focused, I think they had a better chance of proliferating and growing their businesses than those who did unrelated diversifications. I think that's been the bane of corporate India since I was doing banking way back in the 80s. When people went away from their domains, went into unrelated businesses, and then stumbled. Of course, some did well, but the number of those cases were much smaller. But I think those who stuck to their knitting, I think that's one. The other common feature I've seen is in some of this thing is continuity of management and ownership. I think that's also played a big role in many of these things. Continuity of management ownership. And of course, I think the acquisition strategy also then linked to the same thing. Am I going into a completely unrelated domain where I have no knowledge or experience, right? Or is it something which is accruing to my existing domain? I think those are some of the features, but I wouldn't say there's one mantra that really applies on why you made it, right? So various people made it for different reasons. Sometimes change of management cause a change in this thing. Sometimes an acquisition took you to a different level, well thought out. Actually. But mostly you see those who stuck to the knitting and those who kept their people intact, right? So the people who, so if you have somebody who's, if you have a company which, where the CEO has worked for the company for 25 years or 30 years, you probably will see an example of success.
Right. One of the other questions we get a lot from mid-size to small-size companies is how do I make this digital transformation? It's a buzzword, it's, corporate jargon, lingo, everyone is talking about it. And most promoters or entrepreneurs in the traditional businesses
Hmm.
we speak with find themselves at a loss. And I'm just going back to your experience. You took over a bank, and you rightly said that it was lagging behind on technology. So, how did you equip yourself in the first place? Your team, maybe, or your board? Was there any learning involved for you personally as a leader or a CEO? So, how did you go about that?
So, the use of technology, of course, we gave away the idea of you being tech savvy if you had a computer on your table, right? That idea was dropped decades ago. But I think the definition of a really tech savvy company is how they use technology to find customers, service customers, and engage customers. I mean, at least in the banking area, we've used this sort of a stance. How do you use technology? That's one very clear this thing. And it's not about having the latest available, or my mobile is where my mobile banking is faster than yours, and those sort of things. Those are hygiene factors. But how did you use it to create, to find customers, and to then, most importantly, engage customers? Right? Customer engagement is a huge element in this. It's not about how fast the thing works, but how did you engage that customer? I think that's one of the learnings that one has had on how to sort of use technology. So, okay, just start where we left off.
You
So,
were
I
talking
mean,
about how do we find and engage customers, and you're saying engagement is most
find
important.
find service and engage. I think that's really savviness. The other element is this. Now, when we talk about, say, the digital transformation, right? I think what is true of non-digital elements is true of digital elements and all. At the end of the day, you must ask these two questions. What does this do to my revenue, and what does it do to my cost? That's the
Right.
final test of technology. Now you could put elements there which saying, oh, it helps my customer base, so therefore it impacts my revenue. Or it says it reduces my cost of acquisition, right? It affects my cost. I think the ultimate test of that is also. So the transformation to a digital sort of a strategy, if you were to say, from the traditional technologies is not a strategic sort of a change in the stance. You must ask the same questions again and again. What does it do to my revenue? What does it do to my cost? Right? And then say, okay, uh, front office, mid office, back office. Where do I use these sort of things? Then, of course, there's this big debate around can I transform the existing organization into a digital organization, or should I start a new vertical? Right? And this idea of the new vertical had gathered space a lot. We must set up a subsidiary which does that. It doesn't work. At least we discarded that idea. He said that you embed the new digital this thing into your DNA slowly. It will come into your DNA when you think digital, right? When you process digitally, when you face customers digitally. So we followed that sort of a thing. That don't create separate verticals. Don't say, okay, now I'm creating a new digital bank. Yeah, we transfer and transform slowly into a digital DNA. That's the philosophy we have followed.
Right. Thank you. I mean, that is very insightful. I'm sure it will benefit a lot of people who must be listening in. I wanted to now move to the Indian corporate sector, your views, the economy and the banking sector. How do you see the health of corporate India from your vantage position?
Well, you see, it's, the answer actually is a no-brainer, in the sense that the consequences of the pandemic on the economy and what it has done to bottom lines and demand and supply equations is very, very sort of a clear. Uh, the debate is around now what sort of recovery will take place, right? We all know demand has fallen off, almost a cliff. How do we climb back? And there are these various alphabets which are used to describe the recovery process, V and W, and today I heard X for the first time. I didn't know what an X-shaped recovery was there. But I think the sensing in the market is that it's not that massively V-shaped recovery that we are seeing. Some parts are recovering on a V-shaped basis, but other bases are that they are lingering at the base, and then you probably will see a little up curve coming this thing. I mean, the economists have given you all the projections. I don't think I can add anything to what sort of a contraction that you see. I think those numbers are all out, and there seems to be some sort of a consensus for the full year now on 10-11% contraction over this thing. But I would say that you would see a much better rally and recovery on, and you're already seeing it, on the manufacturing sector than on the services sector. The services sector are, massively impacted, whether it's hospitality, whether it's travel or tourism, and all the sectors. They're going to take a long, long time. Today or yesterday, I read one report which says actually tourism won't recover till 2023. Right? So that's a very deep sort of a concern. But I think the other sectors, I mean, I've talked to several captains of industry, and they all feel that they are back to pre-COVID levels on their capacity utilizations, etc. So then, of course, there's a discussion about stimulus and things like that, and there are pros and cons of that. If you are seeing recovery, do you need to give another massive stimulus? Because then you're just giving it away, right? So there's a school of thought which says give it away. I think you've got to give it away selectively. And let's see what has already been done and how it's going to impact. Monetary policy, I think, has played a very, very satisfactory sort of role. Whatever the full firepower of the regulators have been used as far as monetary policy is concerned. Liquidity is flush in the system. The cost of financing has gone down dramatically, and it's probably going to fall even further. The question is pick up in credit growth. I think that's the big thing that faces lenders, for instance, that how does credit growth come up? Which sectors will draw more? Right now, it is pretty subdued. There's, of course, there's the whole issue of the risk averseness. Risk averseness is deeply embedded in the system. Normally, in cycles, I've seen reversals happening in 6 months, 8 months. This looks a much deeper risk averseness cycle. Probably will go into the coming year as well, I think. So I think that's a few takes on the economy and the banking system.
And if I may just ask you, if you were the RBI governor, what are the additional steps you would take just to kickstart or help the recovery process? What are 2-3 things that should be done?
See, I think the regulator has done much more than market expected, I would say. I'll give you one example. And since I was talking about risk averseness, and the NBFC sector, for instance, the risk averseness for the NBFC sector. The issue is simple. I have counted at least 10 steps that the RBI has taken to release liquidity in the hands of banks and release capital in the hands of banks, right? Yet, lending is not happening. So what more should RBI do in that respect, Just a second. So I think the steps that we've taken it's the return of lending, confidence. I don't think the regulator has to do anything more.
Right. And there's so much conversation about the health of the banks, the impact of the debt moratorium, the debt restructuring, extension of this IBC window, and so on. What is your view on how healthy or unhealthy is the banking balance sheet system now?
See, I would say 6-8 months ago, right, you would have massive cause for concern. Of course, one was the impact of COVID. I think now there is a strong sensing that earnings will take care of that impact. Earnings will take care of, cost of funds has gone down, margins are steady, not shrinking so much. I think that's one. The other was the capital overhang. And I think that's been substantially addressed. I mean, banks have raised some $13 or $14 billion. I think that's been substantially. So there was a take that, banks will probably need maybe $16, $17 billion. And I think $13 or $14 billion has already come in. So I would say that the situation today is much better than it was, say, 4 months or 5 months ago, because these two factors have come into play. Of course, bank to bank is going to make a difference. But there's money in the hands of banks. There is capital. More capital may be raised as well. But there's enough and more capital available now. The issue now is the return of confidence on the lending side.
Right. And the other aspect you earlier touched upon was this corporate book versus the retail book, and this focus on retail and, people going overboard on one side. Do you now maybe foresee for the first time in India, maybe there could be large scale retail defaults because of so much of income losses, there's a whole demand shock out there, layoffs and so on. Do you see that is a distinct possibility?
That's been discussed and debated and commented upon to no end. But still in the books of banks and still in the books of, of the commentary from the rating agencies, you're not seeing that. You're not seeing any specific surges that are coming. Even on unsecured lending, you're not seeing that. People expected that 1 year ago. There was such a hue and cry on unsecured lending and all. At least not to my knowledge, there are no surges that have been seen. I think people are, job losses may cause some of that to happen. But, people are very wary about ruining their credit records. You default once on one single product, and for a lifetime, you will not get any lending from the banking system. They all work under the same umbrella of the rating agencies for individual ratings. I think that has kept the retail part going, and it has belied all the expectations that one had seen. Not even 1 year, even 2 years ago, people have been talking about, since retail growth started really growing very rapidly, this whole commentary started on, when is the bubble going to burst? The bubble did not burst, right? I think let's see what happens now because of job losses and things like that. But a lot of the job losses would have already happened. Are they reflecting in delinquencies? At least one doesn't see it yet.
Yeah. And the other aspect in the initial part of our conversation, you mentioned about the search for new opportunities. So as a banker, what is your advice to the banks? What are the areas of opportunities that are out there for grabs?
I think the rural frontier, I call it the new frontier. It's the new frontier of banking. The this government's initial steps have done. So, for instance, when you saw in the first 3 months of this new government, hundreds of thousands of Jan Dhan accounts being opened, people used to wonder why is this happening, right? Then the crores of accounts were opened. Then the Jan Dhan, Aadhaar, mobile, the JAM trinity. What this has done to rural India in terms of making it bankable, right, is being appreciated by many lenders now, right? And that's why this move, for instance, innocent move to merge with Bharat was to get a solid foothold in rural India. I think that this frontier will sort of hold steady and holds a lot of promise. It's not just agriculture financing, they're really small. The Kirana store, there are crores of Kirana stores. Now with connectivity, we have seen how these Kirana stores, for instance, the whole experiment is working out, and how connectivity has improved the viability of these entities and the financeability of these entities, right? The small trader, So I think, and with agri and all doing well, with these reforms now taking place, with the farmer hopefully getting more money in the pocket than the middleman and things like that, I would say the promise of rural India should not be overlooked, and it can be only be overlooked at your own cost.
Right. Actually, I forgot to ask you one more question that was in my mind, because you talked about the supply of credit, the aversion to lend. But is there demand for credit?
Yes. I mean, look at the demand for credit from NBFCs, right? They are starved for growth. Growth has been stalled. So there is demand for credit there, but there is no supply.
Yeah.
So the only supply is now going to the biggies. So the big will become bigger, and the small and the mid-size will have to completely rework their business models unless the credit flow is restored. So there is demand. This is one particular area where it comes to mind immediately, where there is demand.
Right. And to that point, a lot of our customers run, let's say, what we call mid-sized companies, who may be facing this crunch on the credit side. What is your advice to them? How do they go about it?
See, I would say that nothing is permanent. Even risk aversion is not permanent. The cycles reverse. And the return of the lending cycle, maybe this time be linked to, for instance, the vaccine being announced or 10 vaccines being announced and things like that. It brings some confidence. But much more important for the return of the credit appetite is recoveries. This thing about recoveries, slow recoveries. Recoveries give you confidence. Because recoveries, every rupee recovered is a rupee added to your capital, right? The recovery process, of course, there was a surge in the IBC process, and it was going very well. Of course, the lockdown and the pandemic and all has stalled that process, but it had created a new culture of compliance and the willingness of defaulters to settle dues. That gave confidence to the banks. That confidence has to come back. Now, of course, IBC is now there's a moratorium on the IBC and things like that. I think recoveries will play a big role in the return of confidence. So now the mid market is exactly there, mid, right? So neither here nor there. The big guys, as I said, will continue getting money. The small guys will say, okay, merge, wind up. But some of the mid market guys will also be sort of looking at mergers. We've seen one fintech, for instance, merging with a large lender, at least a pedigreed lender. You'll see probably more of that happening. But I think to the mid-market, there is no solution. I mean, if you have been a conservative on your debt raisings, that if your leverages are, see, what's happening? Banks are now putting new covenants. So the covenant of leverage was one covenant. the covenant of the gross NPA is another covenant. How much gross NPA do you have? Now, in the good old days, the gross NPA covenant of 2% was good. It's no longer. But there are banks who have 6 to 8% and 12%. So some of these covenants are also playing a adverse role in the flow of credit to the mid-market. So if you have been fortunate, or if you have been more conservative in raising debt, and if you have sort of your gross NPAs are still in the mid sort of range, then you have a chance. But you are not talking about NBFC, you're talking about mid-market companies per se. I think that cycle will reverse.
Right.
I think nothing is permanent. Risk appetite will come back. Maybe not this calendar year, but once I think this whole shadow of the pandemic and the lockdown goes away, I think risk appetite will come back, because there's so much money sloshing around and there's capital. It has to find an outlet.
The other question is from, I mean, obviously, as a result of this pandemic and whatever has been going on since the last 2, 3 years, what is your advice to these mid-sized companies or promoters, entrepreneurs, on how should they look at the capital structure of their businesses or their balance sheets? Because that is also a question of debate, and a lot of conversation has happened on over leveraging, then deleveraging painfully at many times, selling assets, and so on. What is the right balance? What would you advise these entrepreneurs?
So the only advice I can give you is the learnings one has from decades of this thing, that people have very short memories. They forget the last cycle, right? And then they say, oh, this time is different. And then they over leverage again. So the only advice I can give is don't let it happen again. Don't over leverage. The heydays when the money will slosh around again.
Yeah.
Money sloshed around 5 years ago, 6 years ago. Everybody went into huge leverages. Your valuations came out of just growth, not necessarily profitability, right? And the NBFC sector is a classical example of that. And massive leverages happened. Now there is sufferance going on. But the cycle will reverse, right? Slowly it'll come back again. Don't let it happen again. Right?
Right.
Don't be driven by growth valuation considerations. Basic sound businesses. I think that's the only advice that one can give.
Yeah, so what you're advising is stick to fundamentals, don't get carried away. Liquidity will be ample eventually, because globally that is what we're seeing. Very low levels of interest rates, low levels of growth, massive stimulus, unprecedented stimulus coming in, and therefore a lot of money available to businesses to borrow eventually. It comes to the
So,
banking system, then comes
correct.
to the businesses.
So the question is, don't take money just because it's available.
Correct. Correct.
So, I mean, that's what has happened in the
Yeah.
past. Cheap money available, let's take it and do massive leverage.
Yeah.
And, then, what do you call it? Unprofitable growth, because valuations were driven by growth only.
Right. No, thank you so much, sir, on these aspects. Let me just cut over in the last 2, 3 minutes of our conversation. There's some questions assembling. We have addressed most of them, but if there's something new comes up, we'll address. So tell us about your plans for the future now. Are you going to take it easy for some time?
Well, the DNA is not to take it easy. It's hard coded, So the question is, the good old days, you said, let's put up our boots. It doesn't happen. You never take off your boots, right? So at least in my case, so, remaining associated with industry, with the financial services sector, with the larger financial services sector, not just banking, I think that's the way to go. And some of that activity has actually started. The pandemic has helped, because you sit at home and do the work. So you fulfill two desires at one. But I think it's not the 9 to 5 grind. That's not going to happen. 46 years of that is enough. But the desire to remain associated and see what value one could add to certain areas, that would certainly remain. So it won't hit the newspapers, that's for sure. That happens to the CEOs of banks, but at least it'll give me the satisfaction that you're helping with your experience.
Right. And my final question to you, Ramesh, is if you were to just take the sum total of all the learning and all your experiences, what are the top three things that stand out for you? What have you taken away from this 45 years of experience, life, banking, customers, all of the grind, execution, all institution building? What is your takeaway?
I think the one big one is that honor your commitments. And it goes across the board. The commitments to make to customers, to your colleagues, to people in the institution you work for, the commitment you make to your family. I think that's what matters. I give this example of a commitment that most of us vitiate. So you get a phone call and you say, I'll call you back in 3 minutes, 5 minutes, and you never call back.
Yeah.
That's dishonoring a commitment. I think the big lesson is really honoring commitments. The other one is that, that as you sort of scale the corporate ladder, don't forget the ecosystem that brought you there. And, this belief that, I did it, that belief is a wrong belief. It's the ecosystem that took you on their shoulders. So it's your colleagues, it's people who work with you, your bosses, customers, family, the whole ecosystem. That's why I keep remembering one boss of mine the most. Right? I've mentioned that in an earlier interview. Is that I was working for a British bank then in Greenlace, and he came into my room. And that time of the year, when you came with a white envelope, it meant something is good is going to happen. He came with his white envelope and then handed over this and said, open it. And of course, it was a promotion with a solid this thing. And fortunately, it was a second promotion in 3 years. So that was supposed to be a big deal for this thing. And then he put his arm around my shoulder and he says, remember your friends on the way up, lest you need them on the way down. What he was telling me was, don't forget the ecosystem, right? And it's not you alone who did that. I think that learning has remained with me right through these years.
That is very humbling to hear. And personally, I must say I've learned a lot in this 1 hour interaction. I want to thank you on behalf of Edelweiss, on behalf of all our clients, our team, for joining in today. It's been a great conversation. Really enjoyed talking to you, Ramesh. And all of us wish you the very best in whatever pursuits you are going after. Thank you so much.
Thank you, Anshu. It was my pleasure to join you on this forum. Thank you for giving the opportunity.
Thank you. Thanks a lot, Ramesh. Bye-bye.
Bye. Bye.